Oil prices are rising again despite a coordinated move by major economies to increase the supply of crude in the market. The International Energy Agency says its members are releasing a combined 60 million barrels of crude from their stockpiles. It's on top of the 180 million barrels that the U.S. is taking out of storage over the next 6 months. The group represents some of the world's largest importers of the commodity, and their decision is meant to bring down prices as sanctions mount on Russia, the world's second biggest exporter. But markets were disappointed. The international crude benchmark Brent has risen around 2%, with oil now trading at around $102 a barrel. Let's get more on the story with David Madden. He's a market analyst at Equiti Capital in London. Welcome back to the program, David. Now, can you tell us why markets seem to have reacted in the opposite direction of what the IEA was intending with their move to release millions of barrels of oil from their stockpiles?
Well, to be fair, we have seen the price of oil coming down in the last week or so when the rumors that various different governments around the world were intending to release some of those stockpiles. So overall, oil has declined in the last week or 10 days. You mentioned that Brent crude is around $102 a barrel now. Keep in mind it was around $8 or $10 higher a week ago, just prior to the chatter and speculation that that the various governments would intend to release some of the stockpiles. To use a kind of market terminology, this is a classic example of buy the rumor and sell the fact, or in this case, sell the rumor and buy the fact, whereby something that has been discussed and is likely to happen in the next week or two, traders act in advance of the actual event happening. And in this case, the price of oil declined by $7 or $8, $10. Then when we have the actual announcement that it's all going ahead, as talked about for the last week or 10 days, we see a move in the opposite direction in price. So this has had somewhat of an impact on the oil market, but considering where oil was in late January, early February, or not to mention where oil was prior to the Russian invasion of Ukraine, I think it's, in the grand scheme of things, oil is still quite expensive compared to, say, 6 weeks ago or 8 weeks ago.
Right. So oil still at an elevated level from before the attack began. So what can oil-consuming nations do to bring prices down to where they were?
To be perfectly honest, not much is the answer, which I know that isn't ideal. I suspect that countries that are quite large oil importers will probably call upon oil-producing nations to really speed up the rate at which they're returning oil to the market. Now, when the pandemic hit and the lockdowns were imposed, OPEC Plus decided to take a record over 10 million barrels per day of oil off the market in terms of slashing production, as a way of putting a floor under the price and as a way of kind of bringing supply down to meet the low demand that was in place amid the lockdown. Since then, they've been potentially ramping up demand, and they've been returning around 400,000 barrels of oil per day to the market. Their aim is to get back to pre-pandemic levels of production by September. I suspect Western governments are going to start calling on oil-producing nations, saying, "Would you mind actually speeding up that process? Or would you mind, cranking up the rate at which you're producing oil and get to the pre-pandemic level of production sooner rather than later?" But that being said, it isn't necessarily always easy to ramp up production, and there is an incentive by rich oil-producing nations to keep oil at an elevated level.
All right. David Madden from Equiti Capital in London. Thank you for joining the show.